Let's talk about what everybody wants to know. What's better, dollar cost averaging your money into the market or just putting a full lump sum right into the market and letting it rise over time? Hey everyone, I'm Jay from Investonomics. Let's get right into this one. You're 22 years old, you just started working, you're working in the corporate world, you're making some money, and you're able to save between 10 and 25% of your annual salary. But then all of a sudden, you find out you have a rich uncle who had a huge lump sum, say $600,000, invested into mutual funds, and those are now in your possession.
I'm rich. Hey.
So what do? Do you sell the mutual funds and go buy index funds instead? Do you keep the mutual funds? Do you sell it all and go buy real estate or gold? Now, before we dive in, it is very important for me to emphasize that the mutual funds that your uncle had in that account are very important to understand how they work. They can be one of two things. Either it's a very good mutual fund that's actively managed, that well outperforms the market, and you pay a pretty solid MER or management expense ratio on. And keep in mind, for mutual funds, this is between 1 to 3% versus index funds, which is basically zero, usually under 0.1% management fees. So the only time this makes sense is if a mutual fund outperforms the market very well, then that management expense ratio is worth your money. But the danger lies is if those mutual funds actually underperform the market, but are charging 1 to 3% expense ratios. Then you have to start looking out, because if you're earning 6% versus 7% in the market, and you have to pay 1 to 3% in expense ratios, now you're left between 3 to 5% turns instead of 7. So in these cases, it's very important to understand this and, if need be, sell those mutual funds and put your money into other assets. And if you want to learn more about this and more about MERs, more about mutual funds, we have a great video which I'll link right here, and you can check that out as well. Here's what you should do if you're planning to sell it and putting into the stock market in the form of index funds. So first of all, let's discuss what the premise is of dollar cost averaging. The idea of dollar cost averaging is to get a lower price for your investment over time. Essentially what it means is you're putting a certain amount of money in fixed time intervals into the market. So if you have a set amount of holdings or index funds that you like to invest into, you're putting an equal amount, say every day, every week, every month, every half year, or every year, and you're putting this same amount in at every single interval. Now, the beauty of dollar cost averaging comes from the amount of shares you can buy depending on how high or low the price of the funds are that you're buying. Let me give you an example here. So if you have $100 to invest into an index fund or into a collection of funds, but let's call it one fund for this example. If you have one fund that's priced at $100, you can buy one share of that. So say the first time you dollar cost average, you buy one share at $100. But then the next month, the market isn't doing so well and it goes down to $50. Now, what's beautiful about this is that you can now buy two shares. So at $50, your $100 set interval goes a little bit further because you can buy two of the same shares that you could only afford one of before. Now, the opposite's also true. If the price were to appreciate to $200 per share, you'd be able to buy only half of the share you could buy at that first dollar cost average point. Now, how this works is that over time, you're gonna own more shares at lower prices because that same amount of money brings you further. And when the price is high in the market, you're able to buy less shares. So dollar cost averaging works a wonderful miracle in that it actually reduces your average price over time, which gives you a larger return over time. It also works very well psychologically as well, because as prices go down, you're not scared anymore. You're just excited that you can buy more shares with the same amount of money that you're investing. Now, on the other hand, you might think that it could be better to invest all of your money all at once. And while this might be true, it might be difficult to stomach. And the reason I say this is because if you put a huge sum, say that $600,000 from your uncle, into the market all at once, and you're not used to the market swings, it's gonna hit you like a brick wall.
It is brick wall waterfall.
when you see a $10,000 red day, you're really not going to be in a good headspace. So it's very important for new investors especially to potentially try dollar cost averaging first, get your feet wet a little bit, try out the markets, see those fluctuations, and when you're feeling confident enough, dive right in and buy as much as you want. You can even do it in two or three different times, and just put a huge lump sum into the market when you feel comfortable. In terms of mathematics, investing a full lump sum all at once is mathematically the best way to grow your money. Now, this might seem counterintuitive, but the reason for this is simply because interest compounds. That and the fact that the money, if you are dollar cost averaging and you don't have that rest of that money in the market, it's actually losing value over time. So because of inflation, and depending on how long it takes you to dollar cost average all of your money into the market, it may be years later before you actually get that full amount invested. And at this point, inflation will have eaten away quite a significant portion of this. One way to counteract this, if you are set on dollar cost averaging into the market, is by using something like a GIC, which is a guaranteed investment certificate, or in the United States, a CD or certificate of deposit. These are offered by banks and financial institutions, and they offer a pretty high rate of return for no risk whatsoever, and you usually have to lock them in for about a year or so. And you can also choose longer terms if you'd like, but this allows you to get a return on that money that isn't currently in the market so that you're not losing it due to inflation. So now that we understand how dollar cost averaging and lump sum investing compare, which one should you choose? People who are new to investing, again, should start with dollar cost averaging and get used to the different swings and seeing if they enjoy buying at lower prices and at higher prices, just getting to know yourself a little bit better. And once you feel comfortable with the swings and how the market operates, then just dive right in, put that lump sum in there. But remember, don't sell, and make sure you hold that for as long as you possibly can to let compounding work its magic. On the other hand, if you are a little bit more of a seasoned investor and you come across a chunk of money that you want to invest all at once, go right ahead, put that lump sum into a diversified ETF portfolio and make sure you just put it in there and forget about it. Don't even worry looking at it. That huge lump sum will grow exponentially as time goes on. Well, of course, not everybody is going to have a huge lump sum to invest. It would be nice, but unfortunately that's just not the case for everybody. For people who have a regular 9-to-5 job, maybe they are earning a little bit more, maybe they're earning a little bit less, but they have some chunk left over every paycheck or every month that they're willing to invest. Well, of course, the most logical thing to do here is to just dollar cost average. Since you don't have a huge lump sum to invest all at once, which would be ideal, you can dollar cost average and you can kind of have this as a default. So for those who are employed, this is the best way to do it. Just set aside a certain amount of percentage of your income that you can, and remember to pay yourself first. So always put that investment account, if you can automate it, that would be the best. But always take that chunk first before you even pay your bills, before you do anything, put it in your investment account and just let it grow. And of course, the shares that you buy over time will reduce your average price and you'll earn a great return that way as well. So I hope this was informative. It taught you guys a little bit more about dollar cost averaging versus a lump sum investment. If you'd like to learn more about this, be sure to leave a comment down below and check out all of our other videos. We've got a lot of great content out there about investing, finance, economics, and trading. There's something on our channel for everybody. Be sure to check it out, and I hope you guys have a great week.